Okay.
All right.
All right. So Luke, welcome back to F.A.C.E, buddy.
Thanks for having me.
Okay. So why don't I? There you are. Okay. We're gonna do a talking heads interview here today, Luke. All right. So, Luke, I'm lost in the middle of the forest, and you heard our banter before before you came on. We're looking at all these different trees while we're lost in the forest. I bumped my head on a tree that said Fed, and then I stumbled on a tree that said Ukraine, and then I stumbled on a tree that said agricultural commodities, especially grains, and it made me think we're going to have to learn to eat bark, and it's not a joke, like Yul Gibbons did. All right, you're probably too young to remember Yul Gibbons. He was a naturalist. So if you would please take us to a nice hilltop view of the forest so that we could take a look at and hear from you what the forest is either whispering or, what it's screaming at you right now. Because you and I haven't talked for a while, and there have been some, pretty dramatic things happening in the world.
Yeah, to me, the thing that's probably screaming the most is, I guess, twofold. The first is it looks like we're heading toward a recession,
Okay.
and I think possibly some sort of economic crisis led out of Europe. A recession, let's say, out of Europe, as they're basically committing hara-kiri with the energy sanctions. If they try to do what they're trying to do in terms of restricting gas usage, they're going to have a pretty severe recession. And that then ties into the second point, which is sovereign debt. To me, is still the big issue. Western sovereign debt, and specifically you can't have a recession with U.S. and European sovereign debt as high as it is. One of two things will happen. I've spent most of my time talking about it on the U.S. side. But it's going to force the Fed and the U.S. government into a choice. Either they have to choose for the U.S., they either have to, because tax receipts are running at about 100% of what I call true treasury spending, right? So, or true interest expense, excuse me. It's treasury spending plus entitlements is about 100% of tax receipts, and tax receipts are at all-time highs, inflated by 12% nominal GDP last year, which is of course inflated by 8% CPI. If you have a recession, tax receipts are going to fall. The entitlement obligations, the treasury spending obligations are not. You could layer defense on top of that. If you throw defense on top of those two things, excuse me, it's 120% of receipts. And in a recession, receipts fall. And so then you just say, okay, in the case of the 120% treasury spending, entitlements, defense, which does the United States cut in a recession? By a lot, to try to avoid not having the money to pay one of those three things. And the answer is either they have to cut or the Fed has to print. And to me, it's strange credulity in an election year that they're going to cut entitlement. Strange credulity to think that they're going to default on treasuries. It's strange credulity to think in the current tensions geopolitically that they're going to cut defense. So they're going to have to print. And I think, to me, that is maybe the message of gold and the metals versus is, I think, the reason gold has stopped reacting to rising nominal rates, to rising real rates, is I think gold's looking through the valley and just saying, the people that are buying gold are saying, I don't care. Maybe we get a brief recession. Maybe it even reduces demand for these commodities for a bit. But the more sensitive dynamic is this Western sovereign debt issue, and they're going to have to print so much money to avoid defaulting. I don't care. A recession is hugely bullish gold, and I think that's probably what we're seeing in some of these commodities as well.
So it's only the short-term guys that care if they pay $1,900 or $1,600, which I think is a possibility if we get that recession. I mean, contrarian-wise, Luke, these commodity markets are overheated. It's the most bullish I've seen people in commodities since I've been in the business, maybe since the 70s. Okay, so I think it's that they could take a breather. And it's interesting when you talk about sovereign debt crisis, people really don't even know what it means. You're talking about the treasury market, and do you think that we could get maybe a bear market rally in treasuries in this period? They're also one of the most hated markets out there. What do you think?
I think you could see the action that you just described. I think gold will continue to kind of stand on its own. I mean, you could have a little bit of a downdraft, but I don't know that it'd be as big as, simply because of it is sort of the thing that wins either way. Whether they print without the recession, whether they have the recession or forced to print. Because again, if you have a recession, you're going to have credit risk in sovereign debt. That's a really good environment for gold, not for commodities.
Right.
I totally agree. But I think you could have a bit of a counter rally or counter trend move in treasury bonds. I would agree with that from a trading perspective, particularly when you look at some of the technicals you guys were showing earlier.
Well, could risk off be the catalyst? Because last time during the sell-off in equities, bonds and equities both went down together. Before gold turned, it was going down. It's like only cash was working at that time. So do you think that looking at the forests, that there's a possibility that yields could drop for a while, and that the sovereign debt crisis could be delayed because of that?
I think it is. I think it could look something like what we saw in March 2020, right? Where I don't know that it would be that pronounced a drop in yields, but if the Fed stands back and does nothing, again, I'm going to center in on the U.S. That's where we spend most of our time. If the Fed stands back and does nothing and forces the U.S. government to cut deficits by 8% of GDP, then you're going to have GDP drop 8%. And by way of comparison, it dropped 7 or 8% in the COVID crisis. And so I think you could see in extremis similar type of action where treasury yields fall at first, dollar rallies, and then
stock market
crashes, and then all of a sudden 12 days into the crash, treasuries start crashing right alongside. And I think that's, to me, the spot where the Fed comes in and does what they did last time, which was, hey, we're going to do $600 billion a week in QE to stop this. And so it's a time for a trader. I think one has to be very mindful of the timing and the succession of all these events.
Okay. Do you think they go with 50? Do you think they go with 50, half a point in May and June? Will they be able to get that far? And will they ever be able to get to, balancing their trade account, QT, quantitative tightening?
I don't think they can do the 50, and I don't think they'll ever unload all those bonds. I think they're closer to buying more bonds than they are to selling bonds, to tell you the truth. And again, it goes back to how little I'm seeing in market discussions about, look, the U.S. has a balance of payments problem. They have a fiscal crisis. There is no one to buy enough of these bonds. You're running $2 trillion deficits, and you're talking about a dollar that's going to make the rest of the world trading at a level where the rest of the world are marginal sellers. So the Treasury is selling. The Fed, in theory, is going to sell. Foreigners are going to sell with the dollar where it is. Banks maybe can buy some, but they're limited in scope with some of the banking regulations. So you say,
more supply, less demand.
Who's buying? And so, to your point, you can get demand if you scare enough risk assets out of risk assets into treasuries. But the problem with that is we've allowed debt deficits and the importance of risk assets to tax receipts to get so far stretched that it's, as I was just describing in March 2020, risk assets are critical to driving tax receipts through the consumption link. And so if you can move risk assets sort of over to buy treasuries for a bit, but if you do too much, then you're going to send the economy into a recession if risk assets fall too much. And in a recession, your deficits are going to blow out. Your in treasury supply is going to rise, not fall. And so you actually make the problem worse if you do that. So you actually have, when you talk about the narrowing gaps, the Fed is in almost one of these narrowing channels as well, where dollar gets too strong, the dollar gets too weak, and that it used to be a big channel, and it's getting smaller and smaller and smaller.
Compressing
their operating room.
Okay, so you talk about the dollar, and to me, it looked like there was a chance that it may have turned. There could be another push to new highs. What do you think is really going to be the catalyst? Is it could be interest rate differentials? Could what we did by weaponizing the SWIFT system motivate people to speed up their de-dollarization? There was some talk that Saudis are going to take yuan for oil. Do you think there's a chance that the Saudis may begin to price crude oil in a different currency? That would be the end of the petrodollar.
Yeah, I think they're already doing so on a modest basis. I think they're going to get more aggressive with it, particularly after what we did with FX reserve sanctions. I hear credible rumblings that they found that our sanctioning of Russian central bank reserves terrifying, and rightfully so. And so I think in the long run, in the intermediate term to long run, the fundamental outlook for the dollar is extremely weak, by virtue of, in no small part, based on what you described, which is there's a de-dollarization of global FX reserves happening. There's as you can price oil and commodities in other currencies, there's less need to hold FX reserves with less in dollar terms, excuse me. Yeah. And you're also seeing the U.S. pushing people to that decision with the sanctions on central bank reserves. Treasuries are suddenly risky for sovereigns to hold in FX reserves. Well,
they're saying. Go ahead.
Yeah, I was going to say I think there's a fundamental weaker demand structurally for dollar reserve assets at the reserve level going forward. Now, in the short run, I think a lot of it depends on events. I think tactically, I'm actually bullish the dollar. I think it could get a little stronger before something really breaks. But when I look at what Europe is doing, obviously the biggest components to DXY are the euro and the yen, and I look at the Eurozone, and I don't think people fully appreciate the economic catastrophe that's brewing over there. You can't do to energy costs and supplies what they're doing and not have a severe drop in GDP. And you can't have a severe drop in GDP with debt where it is. That's going to bring in the euro. The ECB is going to have to print into an inflation spike to prevent the default on sovereign debt there. And then the US is going to follow the same playbook on, shortly thereafter, in my view.
So if the dollar is peaking, Luke, and the way you describe Europe, the euro doesn't sound like a real attractive candidate for a dollar hedge. What fiat do you like? Commodity producing countries?
It's
I don't like any of them. It's okay.
I tactically I'd like the dollar, but I don't like I'd probably look at the Swiss franc. Is probably where I put money. I mean, they're printing francs and buying U.S. corporations. That's not a bad gig. Beyond that, I think I still think too the you can't really trade it as a problem, but the yuan I think has been quietly over the last 6 to 9 months rising against the dollar, despite the dollar tightening rate or the Fed tightening rates and the PBOC loosening policy. And that's, I think, whispering a very important message to the market that the market, still tends to ignore because it's China, it's a closed capital account, they're communists, they're emerging market. And the market's telling you something might be changing there. Chinese government bonds have outperformed U.S. Treasury bonds on a 2-year, 3-year, and 10-year basis. Most people, myself included, as of a few weeks ago, were shocked to learn that. The markets are speaking. Nobody's listening because they're just saying, "Oh, it's China and they're bad, China bad," and that's it. And things need to be painted sometimes a little bit more shade of gray. But
so maybe China's ahead of what the Fed's going to have to do as soon as the real estate market caved. They did switch to more easier stimulative policy.
Yeah, I think that
Evergrande.
I think that's probably a big part of it, right? Is the perception that there is more GDP growth there, right? That they're taking steps to support GDP growth and the support of the currency. I also think that what they're doing with yuan denominated commodities, as we were talking about earlier with the Saudis, completely changes the game for how we look and think about China and the yuan as a currency. All of a sudden, you start having offshore yuan balances that can be recycled back into Chinese assets. You talk about China as being a nation that can print their own currency for oil, gas, and other commodities. And when you look at China's balance of payments, that's the biggest outflow of dollars historically. So every 10% of commodities that China can shift into yuan increases their dollar liquidity that year by $150 billion with commodities at current prices. And that's in addition to the 30 billion a year we're currently sending, excuse me, 30 billion a month we're currently sending China in dollar liquidity via our trade deficit. So there is, and I think in addition to the stronger growth, there's this angle that that the yuan is becoming less and less susceptible to the traditional emerging market dollar liquidity balance of payments crisis that a lot of people that were shorting yuan over a few years ago.
Okay, so we could take a look at the yuan and see what it's doing, because there was a pretty good move, and so maybe that's it almost looked like the yuan was getting ready to devalue. And I look at this long-term chart here. Here's your daily, here's your weekly. Doesn't it look like there's some type of bottom developing there, Luke, in US dollar yuan?
Yeah, I mean, it does technically.
Yeah,
it does look like it's, and you know, again, I think it's underappreciated, the dynamic that this yuan oil in particular, but yuan commodities gives them in terms of flexibility. Because if you can, as a trader, you think about it, if you have flexibility in which commodity, in which currency you buy your commodities in, and the commodities are your cash outflow, and you can buy them in yuan or in dollars, your choice, then suddenly, based on the blend of commodities, the blend of currencies in which you're importing your commodities, you can start to manage your currency relative to dollars, right? You can start to manage the yuan dollar cross rate based on the blend which you are bringing in commodities, the currency in which you're bringing in commodities. And so that is a lever that is completely new for any emerging market, any other country in the world. Historically, it's been, hey, you know, the yuan either needs to slow economic growth, or they need to, you know, sell dollars to defend the yuan. If you look at their FX reserves levels next to that yuan dollar chart, what's really interesting to me is that it's not moving. It's not growing really, but it's also not shrinking. So they're managing to keep the yuan stable while FX reserves aren't moving, which is sort of exactly my case all along on why I think yuan energy, yuan commodities is so powerful. Is it allows them to manage the value of the yuan using commodity markets relative to the dollar, without having to buy and sell dollar bonds, which then flips back to our point earlier that, you know, fundamentally I think there's been a sea change in foreign demand for treasuries and for dollars broadly that I think is heading one way in the long run.
Well, this guy doesn't want dollars anymore. There's your US dollar ruble, right, Luke? So you know, he wants euros. He wants anything but the dollar. He'll take anything. Does this say that Russia really didn't get hurt that much by the sanctions? The fact that we've almost recovered. Some people say the price structure that we're getting since the invasion, the prices aren't, you know, you can't count on them. But to me, it looks like they've recovered most of their losses, you know, from 160 back to 96 in 2 weeks, is a recovery in the ruble.
Yeah, and you know, I didn't think he'd invade. He did. He surprised me. I think he surprised a lot of people. But after
he probably surprised himself.
You know, after he did that, I was pretty vocal. I said, look, I think that Russia has way more leverage than people think, and that ultimately there's going to be a marking to market of relative power levels between the West and between Russia. And I think we're watching in real time as that is taking place. And the basis for my view was I actually said in 3 or 4 different interviews, I said, listen, I think there's going to be a tiering of their responses. I think tier one's going to be, okay, fine, we're only taking rubles for our energy. And then I think tier two is, okay, then we'll only take gold for our energy. And he has sort of done both of those things in sort of a hybrid manner. But I sort of laugh at, I've been seeing some of the U.S. officials over the weekend say, well, the improvement in the ruble is not really a free market. Right. And it's like, yeah, great. Now do treasury bonds. Now do the Fed's balance sheet. Now do, anything, a lot of different Western financial markets that aren't nearly as free as they used to be. I think they were surprised by his actions and how effective they've been. And to me, what it's telling you, what that chart tells me, is that if I look at the petrodollar, the real value is in the petro, not the dollar. And I think that chart is sort of a great big statement that the real value is energy, and it's not the dollar. You can print dollars, you can't print. You can print dollars, you can't print energy.
So it's their reserves and capacity for putting out such a major proportion of global oil. It was the cause of this, besides the fact that they tried to shut down the central bank. That natural forces, someone was buying the ruble, and the central bank was kind of handcuffed, wasn't it? Who do you think was on the other side of this trade? Wasn't the Fed?
No, it wasn't the Fed. In terms of the weakness of I mean, it's
the recovery.
The recovery. Well, they just came out with their reserves the other day. With the reserves the other day, they did burn 30 billion or so before they got locked down. But again, I think that's in the green candle. That's not in the red candle. I think the other side of it is probably the Indians. I think it's probably people buying energy, saying,
China.
I mean, look, China. If all you got to do is buy the ruble and you get a $30 per barrel discount, and then by the way, with China's refining capabilities, you could turn around, refine it, and sell off the refined products in the region in dollars. Like, why not? It's literally, we're handing money of these sanctions. We've changed the reference point to oil, right? As all of a sudden, it's all about the dollar, it's all about the dollar. Well, this shows us it's not all about the dollar. It's all about oil. It's all about gas. And so as long as they have China and India, these massive buyers of energy, then discount it properly, they'll buy it. And a couple of them, if they can use it and benefit their economy, or they can refine it and sell it off at the full international price, and it's free money.
Do you see an end game to this conflict in Ukraine?
I think, to me, the end game all along, from a big picture perspective, I think on his point has been that this would trigger a financial crisis in the West. That the West, this is basically a balance sheet contest. In other words,
interesting.
He can, he had to have known that we were going to sanction him. I think the central bank sanctions were maybe a bit of a surprise, but that chart shows that they've been able to parry that blow pretty successfully. I think it was effectively, hey, if they want to sanction me, they're going to have to shut down their economies put their economies into a recession. And if they put their economies in a recession, then they're going to have a sovereign debt problem. And when they have a sovereign debt problem, that is likely to be dealt with by money printing. And so I think,
which makes all of his assets in the ground, above the ground, worth more.
And so I think that has been a part of the calculus. As far as the geopolitical end game, I don't have a strong feeling one way or another. I mean, he's been pretty clear for 15 years that Ukraine is not to be a member of NATO. And so I think some of it was just, hey, he felt like it had to happen here and now. And if you gotta, he's on the record saying if there's going to be a fight, you're better off picking the ground, picking the territory for the fight. So maybe it's just, as simple as that. But I do think there's been this understanding of my balance sheet's better than their balance sheet, and I've got energy and they got fiat. So let's go.
Okay. And a real interesting thing I read in your writings, and I want to make viewers and attendees, aware of your stuff. And, you know, a lot of people have said to me in interviews over the years, Luke, that they learn the most from their mistakes. And I was reading, you were talking about how you bought a house at the top of the market in 2008, and you were the only person bringing in income. And it was that event that led to you wanting to investigate and really understand how mechanically and esoterically and in every way the economy works and how it isn't working. And it actually, did it launch like a new career for you when you got involved in this?
Yeah, I mean, I was able to see it did. I think really for me the 2008 timeframe forced me to start looking into, okay, how do things actually work? And what I found was pretty horrifying, and so it's been very it's been a very big driver to just
Where did you
really trying.
start when you wanted to find out and you wanted to learn? Where did you start?
It was interesting because it was really a process, because I was working at a brokerage firm, and I quite frankly saw what was happening. I mean, late 07, I went to 100% cash in October of 07
Okay.
because I thought that there was a significant chance the system was going to collapse, the banking system, based on what I'd seen. And so I was, but it was one of those things where even if you're ready for it, it's like, holy cow, like I was right. It might. And then
Yeah.
I think the process of, hey, they're just going to print money. Hey, how they'll change the rules on the fly. And so it was a process, right? When they started QE, I think I did what a lot of people did, which was go buy a book about Weimar Germany because we're going to have hyperinflation. And I read
Right.
that and I say, okay, there are some things that are similar, but there's a lot of really important things that are different. So it's not the same as that, but it's directionally more like that than the way things used to be. And so it's really been just sort of this, self-taught trial and error observational path over 15 years now. That is, and it goes on every day in terms of learning, because there's so many things happening that are so, I mean, if I would have sat down and described to you financial markets in 2006, 2005, and I said, here's what it's going to look like in 2022. You'd have thrown me out of your office. This guy's crazy. Don't ever let him come back in. And yet this is our operating environment. So it's just, I think the key is just this constant strive for trying to understand what's happening, trying to learn what might happen next. And I think that really all kicked off in 08.
All right. Well, I've seen some of the testimonials by your readers, Luke, and you definitely add clarity to a lot of people's the way they look at things now, and you do great work. I believe that you're launching a new or different product at
It's just
FFTT.
we've got a mass market product that we've had for about 4 years now. It's been a very successful product. It's something we do a launch on once or twice a year, just to try to bring some new people into the fold. And so we just finished that yesterday at midnight. It's called Tree Rings. It's a 10 most interesting things report. Ends up being about a 20-page report most weeks, and it's just things that I've read that I thought were really interesting, and a brief synopsis on what I thought was interesting about them. And that way that usually looks is it's interesting because it either fits with something I've been seeing or talking about, or interesting because it doesn't fit. If I'm tactically bullish on the dollar and something shows up that, wow, that's actually really tactically bearish, that's interesting to me, or vice versa. And across different markets and with a geopolitical blend, commodity blend, et cetera, there's a lot of different things we touch on. But that's, I think it's a big reason why it's been as popular, is it's just sort of, lots of different areas and willing to go either way, depending on what we're seeing.
Well, thanks for giving us a view of the forest, buddy.
Absolutely.
Today, and only you can prevent forest fires, or should I say, only the Fed can prevent forest fires.
Yeah, they're going to need a lot of water.
All right. Well, you had a lot of fun with you, Luke, today, and really appreciate you you're sharing your views, and maybe this is your tagline on for the new service. Don't wait to buy gold. Buy gold and wait.
That's probably, I'd point everybody to that ruble chart, right? It's like, well, I'll buy, things change very fast, both up and down. So
Yeah.
I think that's important.
All right. Everyone, Luke Gromen, and you can follow Luke on Twitter at Luke Gromen, and definitely check out his new letter, Tree Rings, where you actually, Luke goes out with a saw and cuts down the trees so he could see how many rings are in there to tell his readers about. So, Luke, good hunting, buddy. I appreciate it.
Thanks for having me on. It's great talking to you again, Dale. All right, take care.
Have a great spring.
You too.
That's a wrap, everyone. I hope you guys enjoyed it. And you could join the team in about 13 minutes on the Morning Edge, and that's going to be a wrap. You like it? Like it, Paul? Okay. All right. Glad you enjoyed, everyone. Don't forget to sign up for the, it's going to be a great conference. Don't forget to sign up for a subscription. Don't forget to sign up for the Trader Funding Program. So lots of options for you to expand and get better and grow. Did you? Okay, Hugo. Enjoy. And remember, don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.